Good afternoon and welcome to the Facilities by ADF PLC half-year results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives in the meeting itself. However, the company can review all the questions submitted today and will publish their responses where it's appropriate to do so. Before we begin, I'd like to make the following poll. I'd now like to hand you over to Martin Proctor, CEO. Good afternoon to you, sir.
Good afternoon. Thank you for that. Good afternoon, everybody, and welcome to Safran's presentation. So I'll just start off with giving you a brief of our highlights. So ADF continues to work with many of the world's largest film and TV companies supplying productions such as The Diplomat, Slow Horses, The Witcher, Hijack, and The Gentleman. A resilient performance in H124 with revenues at 15.2 million, 17% ahead of H223, and adjusted EBITDA at 2.5 million, 64% ahead of H223 as the industry begins to normalise. We recommenced our organic growth program, having put CapEx plans on hold over the strike and subsequent resettlement period, and fully integrated Location One, acquired in December 22, with a significant increase in joint production activity. We also, you might have seen last week, acquired AutoTrack Portable Roadways on the 10th of September to extend ADF's one-stop shop reach. And we have a healthy acquisition pipeline as we continue to review all opportunities in line with strategy and acquisition criteria. The underlying market drivers continue to provide confidence that demand will continue to grow over the medium and long term. And FY24 proposed interim dividend of £0.005 per share. If we can move on to the next slide, please. Some information about our market. So as I just mentioned, a strong, resilient market in the UK with continued investment in UK production facilities and the industry. It's estimated that over 9.5 billion is expected to be invested in London alone in the next few years. Spend in the UK on film and high-end TV at 2.9 billion in Q2 24, up from 0.9 billion for A124. Pinewood Studios recently reported a revenue in Q2 24 up 38% on Q2 23. And last week, you may have seen that Warner Brothers Discovery announced that more than 6 million subscribers signed up to the streaming service in the third quarter. Also in August, Amazon Prime acquisition of Bray Studios is further evidence of the expanding market, and the government continues to support and remains very compelling with the corporation tax and business rates concessions for the industry. A bit about ADF strengths. So we have high value productions and customers, the industry leading quality of service and fleet, highly efficient and fit for purpose facilities and locations with room for growth, and an exemplary net promoter score, not less than 80% since measurements began in FY21, and we're currently at 87%, which I think is world class. The competitive landscape, it remains the same. The facilities market continues to be dominated by two volume suppliers, ADF and Translux International, with turnovers of circa 35 million, followed by two middle tier suppliers, Movie Makers and Onset, with a turnover of circa 15 million each. And below this, there are a plethora of smaller family businesses. If we just move on to the next slide to our customer base. 6 months to the 30th of June 2024, ADF worked on 38 productions across H124, 46 in H123, and the average revenue per production in H124 was 304,000 as opposed to 361 in H123. This does not include Location One. The largest platform in H124 was the BBC, which reflected the general switch of work from US streamers to UK domestic producers over the course of the actors and writers strike and the subsequent resettlement period. The booking lead time reduced to circa 3 to 4 months, but as the period progressed, this has begun to extend to 2024 full year and outlook for FY25. For FY24, the order book continues to build in terms of volume and size of productions as the market normalizes, and the order book for FY25 is likewise building and significantly ahead of previous years. Move on to the next slide, please. So talk a bit now about growth strategy, and this is organic. So during H124, ADF put its major capex plans on hold to preserve cash as the market normalized. During H124, ADF added 14 units and disposed of 3 units from the fleet. At the start of FY24, ADF had 703 units, and by the end of H124, this had increased to 714 units. We continue to work with Paneltex to develop a prototype of new artist trailers with an aim of purchasing units in FY25. And with the resumption of high volumes of trade in H2, we have commenced a limited increase in capex, predominantly with DAF. A bit about our M&A growth strategy. So as I mentioned earlier, Location 1, acquired in 2022, our first acquisition, is now fully integrating into ADF systems and processes and is delivering the expected efficiencies, having consolidated IT systems, insurance, HR support, financial procedures and reporting, sales and CRM platforms. Location 1 opened 2 new depots at ADF sites in Wales and Longcross and 1 new site in Glasgow. And during H124, ADF and Location 1 jointly worked on 32 productions out of 38. Next slide, please. So Autotrack Portable Roadways. Autotrack is the UK's leading supplier of portable roadways to the film and TV industry, and we acquired them on the 10th of September in a deal worth up to 21.3 million. We are continuing to assess other M&A opportunities in line with our investing criteria and IPO commitments, and we currently have several active pipeline opportunities at various stages of development with parallel and diversified business activities, but all still broadly in the film and TV and outdoor broadcast. So next slide, a bit of information about Autotrack. So Autotrack is the market leading supplier of portable roadways to the world's largest production companies and streaming platforms in the TV and film industry. One of the largest privately owned suppliers of panels to the UK TV sector, with a client base of 165 plus built up over 30 years. A diversified revenue streams with panels also supplied to festivals, events, construction industry and other outdoor events, and adds FY23 revenues of 8.3 million and adjusted EBITDA of 4.3 million, and is expected to be significantly EPS accretive following Autotrack's integration into the group. Move on to the fundraise. ADF raised gross proceeds of 10.5 million to fund the acquisition of 100% of Autotrack. A strong pipeline of attractive near-term bolt-on acquisition opportunities remains, and the acquisition of Autotrack is a further endorsement of ADF's aspirations to generate £100 million revenue in the medium term. And with that, I'll hand over to Neil Evans, our Chief Financial Officer, who will go through the profit and loss slides with you.
Hi there, everyone. So a quick walk through P&L for H1. As we highlighted in the recent fundraise, first half of this year was impacted by a reset in the industry after the strikes in H2 last year. And that reset has taken a bit longer than we would have liked. Last year, while the strikes were ongoing, ADF had to aggressively go after every production in the market, but so was everyone else, of course. But we were very successful in getting work in the circumstances, but we did have to offer discounts at a higher level than we are used to. And so it's been a similar situation in H1 this year. The work available was mostly kind of similar UK domestic productions in H1, while the major US streamers realign all their schedules, studio time, scripts, actors, availability, funding, etc. However, there is good progression now and momentum across the summer months in H2 in terms of the volume of work. So for H1, revenue was 15.2 million, which was 17% up on H2 last year. But as you can see, it's well down on H1 last year prior to the strikes, which was actually a record period for ADF in terms of revenue and profitability. The gross margins improved from 30% in H2 last year to 36% in H1 this year, as the volume of work starts to build. We ran the business very tightly, over the entire period, and for H1 this year, we kind of pared back to essential activities. And we finished H1 with an EBITDA of 2.5 million, which was up from 1.5 million in H2 last year. There's no corporation tax payable this year, or certainly this year, because of our kind of excess brought forward capital allowances. So there's just a small credit movement on deferred tax. And also, so the loss after tax was 0.6 million for H1 this year, compared to a loss of 1.8 million in H2 last year. In terms of dividends, we paid a final dividend for last year of 0.9 pence per share, and we'll be paying an interim dividend for FY24 of 0.5 pence per share on the 25th of October, and obviously that'll be based on a kind of significantly increased number of shares following the recent placing. So that's the P&L. Just flip on to the balance sheet. Starting with fixed assets, then CapEx for H1 was relatively low compared to the last couple of years for ADF, and really limited to some existing commitments that we couldn't really push forward. We only spent 1.2 million, and that was spent mainly on generators, some schoolrooms and toilets, which we were short of. We financed 0.7 of that via hire purchase, and we paid the remaining 0.5 million in cash. As Miles mentioned, we added just 14 units, but we also sold 3 older tractor units, so the net increase was 11 in total, and by the end of H1, we had 714 assets. Moving further down the balance sheet then, hire purchase agreements at the end of H1 totaled 14.7 million, and that's down from 16.3 million at the end of last year. And just to re-emphasize, these are not operating leases, or these are assets that we own from the outset. Also on the balance sheet, we have IFRS assets and associated leases, which is almost entirely made up of the capitalized value of our Longcross property lease. The lease liability at the end of H1 was 8.6 million. There's no other debt in the business, so the net debt position at the end of H1, excluding those IFRS leases, was 13 million, and that's down a little bit from the end of FY23 when it's 13.5 million. In terms of current assets, the increase in trade payables and trade receivables you can see there from H2 last year to the end of June this year is purely down to the lower operating levels at the end of December last year due to the strikes and also due to the Christmas hiatus. So really you have to compare the June figures this year with the June figures last year, which are kind of more in line. So that's it on the balance sheet. Just flip on to the cash flow. So our EBITDA of 2.5 million turned into an operating cash inflow of 2.7 million, which is what we'd hope to see. And the main cash movements below that then were HP repayments of 2.8 million and those IFRS lease repayments of 1.5 million, which is effectively our rent for those properties. As mentioned, we also paid 0.5 of a million in cash for fixed assets, and the final dividend for last year, which you mentioned, that was actually 728,000, and that was paid in H1 this year. Overall, therefore, there was a cash outflow of 1.8 million, and that meant the cash balances at the end of H1 were 1.7 million. Let's run through the finances. I'll hand over to Mars now just to kind of summarise.
Okay, so just to summarise and bring up about the outlook. So ADF is the leading provider of premium production facilities to the ever-growing film and high-end TV industry. We offer a progressive dividend policy. A limited supply of premium production facilities gives ADF a strong commercial advantage, and the UK remains a world-leading destination for film and TV production. Strong market drivers and business model provides a platform for sustainable growth and strong earning visibility due to the increased demands, scale of productions and booking lead times re-emerging after strikes and subsequent resettlement period. And we've invested in the right teams and resources to enable our ability to scale. Aspirations, as I said earlier, of 100 million revenue in the medium term and a complementary acquisition opportunities as part of our growth strategy. And we'll pause for some questions.
Miles and Neil, thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab, which is situated on the top right-hand corner of your screen. But just while the company take a few moments to review the questions that have been submitted today, I'd like to remind you that recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. As you can see, we have received questions throughout today's presentation. And Miles, and if I could hand over to you to read out those questions, that'd be great, and then I'll pick up from you at the end.
Okay, first question from John S. Given the acquisition of AutoTrack Portable Roadways, how significant is the events and infrastructure market as part of your strategy to diversify revenue streams beyond film and high-end TV? Okay, that's a good question. First, I'll just emphasise that in terms of ADF and off-city vehicles, we're not looking to diversify into those areas. We're sticking with television and film as it's quite unique to our vehicles. However, having been through the strikes, looking at AutoTrack and some other acquisitions in our pipeline, we thought after having endured the strikes that it would be sensible for us to look at some businesses that have some diversity and other income streams. So a business like AutoTrack is perfect for that because it is established in the industry. It's well established. It's been going for 30 years, but it also has a footprint in the events. So if you can imagine, they do things like, I don't know, Cheltenham, Ascot, internationals, large sporting events where there are marquees and catering. So everything from the Olympics, the Christmas fairs, Blenheim Christmas Fair, Harry Potter Christmas Fair. So lots of events, and also they work in construction and with crane companies. So when they go into schools to move portable classrooms, they have to put tracking down to put the cranes on, etc. So they've got a bit of diversity there, which appeals to us. They've grown a very healthy business there, but we feel that with our infrastructure, we're able, and the ability to put capex into that business, we are able to grow not just their market share in the TV and film industry, but also increase their market share in events and their diversified market. So I hope that's answered that question. Next question, it's John S. again. With long-standing relationships with major production companies, how do you plan to strengthen these partnerships, and are there any new opportunities with global streaming platforms or traditional studios? So that's good. Another good question. But the answer to that is that most of our customers, the majority of our customers, in fact, are line producers, executive producers, and transport captains. And these are predominantly self-employed. And they move between production companies and streamers. So although we are preferred suppliers and preferred suppliers lists with NBC Universal, Apple, Netflix, ITV, BBC, the people that make the decision to use us on a production are the producers and the production managers and the line producers who are self-employed and move around. So if I give you an example of that, one of our customers, the last job we did with them was with Lucasfilm, Star Wars, and now we're doing a Marvel film. So they move around constantly, and we go where they go. Hopefully that answers that. Next question, Tom F. Do you have an estimate of the synergies of the recent acquisition, and do you see scope for similar synergies for further M&A opportunities? Yeah, so we do. A big thing with these businesses that we've acquired to date is that we have the advantage of having up to 7-month lead time to productions. Location One and AutoTrack, their lead time is 4 to 5 weeks. So, we're talking with productions that are starting next March, April, May, June. These guys don't know about those. So it obviously gives us vision of what the requirements are going to be like. And we have an understanding of which productions we'll be working on. And then we can talk to those productions and we can offer, offer them the one-stop shop and the opportunity for multiple bookings. So the big thing there is awareness of which productions, and then the actual synergies within our business. It's just about utilising our assets. So we have obviously we have a transport department, a human resource department, administrative department. So kind of all the insurances can come under one roof. All the transport, maintenance, purchasing, servicing can come under one roof. All the human resource issues and sales. So we have a CRM system called Salesforce that we utilise, that we currently work and share with Location One, and now we obviously share with AutoTrack. So they are the main synergies, and as I said, the big thing there and the advantage for these companies coming into working under the ADF group is the advance notice of productions. Stephen K, with significant investment in your vehicle fleet, how do you balance between maintaining fleet quality and managing costs? And what are your strategies to ensure efficient fleet utilizations as productions ramp up? Right. So unlike AutoTrack and our friends at Location One, our business is a bit more complicated because all our vehicles have to be MOT'd and have to be serviced every 12 weeks. So when these vehicles go out on a production, maybe let's talk as an example, they go out on the Gentleman and they film for 30 weeks. For that period of time they're out, they need to be serviced. We get them MOT'd before they go out, so there's no issue with that. But at the end of that period, when they do come back, and don't forget that these vehicles are out there working. They're not doing so much necessarily much mileage. So to give you an idea of that, general haulage companies, vehicles that work in general haulage tends to do up to 150,000 miles a year. Our average mileage is 25,000 because they're predominantly parked on a base and they don't move very far. So the big difference for us is that the vehicles, costume trucks, makeup trucks, production offices, they are working spaces where there are teams of people working in those vehicles for long periods of time, and they're going to get knocked about and cupboard doors come off, etc., etc., and there's going to be wear and tear. So when vehicles come back after being out on a production for a long period of time, we have to put them through a clean and prep process where they come back in, damage is assessed, repaired. So when they go out again, the functionality, everything is and the standard is high interior wise, and the maintenance side in terms of the mechanical side, the MOTs are done and they're serviced before they go out. So that's something that we've been doing for a long time now, and it's a smooth transition from when they come back in and they go back out. A big thing about our vehicles is that everything is quite unique, and our vehicles aren't things that you can buy at a dealership down the road. So they're bespoke, they're fitted out and bespoke, so they hold a lot of value. So to give you an idea, earlier in the year, in January, we sold 2 makeup trailers that we bought from a Canadian company in 2014 for £45,000, and we sold them in January 2024 for £35,000. So they hold a lot of value. And then the smaller suppliers, or we try and sell them out into Europe, will buy those vehicles and then they'll refurbish them and then put them out. Next question, Tom F. Any update on A1 potential impact on your business? I recall you talking about the new Gladiator films superimposing the crowd in the Colosseum using small sections of extras and film during the... There's no... It is as it was when we last spoke. There's no advancement there, and I think I probably told you this last time. These productions and these actors, they have image rights, and they're a bit like footballers and sports people, and they're very, very highly controlled. So we don't see any real advancement or risk in that in terms of the general filming. Just in areas where they're using it for extras, like in the Gladiator where they're superimposing for the crowd. Another question, John S. Is Autotrack's CapEx profile similar to ADF's? I'll let Neil answer that.
I'm sure you mean the profile, but they do want to spend some money next year. They've been down already with kind of a begging bowl. But they run the business very carefully over the last couple of years, and they paid for everything out of their cash balance. I know they haven't financed anything. So they have run basically for the last year, okay, excepting there's been a strike, which has depressed sales, at the limit of their stock, their inventory. So with the effect of the strike receding for them, really, May, June and July, they've been at the highest level of sales they can be at, really, with the level of inventory they've got. And they've actually been hiring in equipment from their competitors to service demand. About 10%, the top 10% of their sales is actually being provided by a competitor. So they know they're not making the margin then on those additional sales where they're hiring in. So they know, and they can see their order book now to the end of the year is very full. So they do want to spend some money. And what they proposed is to spend £2.5 million in the first quarter of next year, £500,000 on some vehicles to move stock around, and then £2 million to buy another load of panels. And the panels themselves are £1,000 each. So they get another 2,000 panels, and that'll take them from about 17 or 18,000 panels up to 20,000 panels. But there's a lead time on the vehicles, which is a bit on a sort of critical path in a way. There's no point buying the panels if they haven't got the vehicles to move them around. So they got to go hand in hand. So yes, Q1 next year they want to spend £2.5 million, and that really set them up then into a sort of a 15 to 20% more capacity for 2025.
Are there any more questions? I don't think there are any more.
Mars and Neil, I think that's all of them. Thank you very much for answering the questions you can for investors. Of course, the company can review all the questions submitted today, and we'll publish those responses on the Investor Meet Company platform. Just before redirecting investors, provided their feedback, which is particularly important to you both. Marsden, could I just ask you for a few closing comments?
Thank you for taking the time to join us today. All I would like to say is that the outlook for us is extremely positive. We're really pleased with our recent acquisition, and as I said earlier, we have a couple more in the pipeline, which are going to help us get to where we want to be in terms of our objective of having 100 million turnover by 2026. Thank you for joining today, and we look forward to seeing you next time.
Mars and Neil, thank you once again for updating investors today. Could I please ask investors not to close the session, as you'll now be automatically redirected to provide your feedback in order the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Facilities by ADF PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.